Hello, and welcome to Accountable by Shorts. I'm Kirsten Amor, digital content lead here at Shorts, and in today's episode, we're covering the biggest myths and misconceptions behind inheritance tax. Now, inheritance tax has captured the public's attention in recent years due to a combination of frequent headlines, but also changes by successive governments. And this has created a mixture of well-meaning tips sitting alongside more dubious ideas or schemes that is now circulated among popular culture. The truth is, there are many opportunities to pass on your wealth efficiently and reduce your inheritance tax liability, but these require planning well in advance, which is something most people don't realize until they're sitting on their deathbed. So joining me to break down the biggest misconceptions and share some practical advice with you all is Shorts tax partner Craig Walker and the Shorts senior manager to the private client team, Mark Trevenna. Welcome, guys.
Thank you, Kirsten. Thanks.
Okay. To give a bit of background, both of them are qualified as chartered tax advisors and have extensive experience in estate planning and inheritance tax as well. So before we kick off with all the nitty-gritty myths, just want to cover a couple basics with you guys. Craig, could you just tell us what exactly is inheritance tax?
Okay, so inheritance tax, in a nutshell, it's the tax that you pay on death, on the value of your assets on death. It's one of the most unpopular taxes in the UK. It's a very emotional topic. Lots of people see inheritance tax as almost a double tax. So you pay your tax on your income, pay tax when you pay stamp duty, land tax when you buy a property, and then there's a further tax charge on death. So very unpopular tax.
I think the one thing that's really important to note is that with inheritance tax, it's actually one of the taxes which is the easiest to avoid a liability on.
Yeah.
So whilst it's unfair, it's also avoidable.
Can you just tell me, why is it important then if it's so easily avoidable?
So it's important because ultimately most people want to make sure that their wealth is going to the people they want it to go to. So if you're happy for 40% of all your assets to go to the government, great. You don't need to do anything. But otherwise, if you want it to go to your family, your friends, or even to charities, then really that's why you need to think about it.
And when would you say is the ideal time to be considering inheritance tax? I think, like we said, most people don't think about it until they're near the end of their life. But equally, if you're quite young and just starting out, you might feel like, I don't have that much in form of assets or money right now. Do I really need to start considering it?
Yeah, as you say, Kirsten, many people think it's not something I need to look at right now. I'm not old enough. I don't have enough assets for it to be an issue. But we tend to find that the sooner people come to us asking for advice, the more options it opens up. So it's certainly not something that you should put off. The sooner you start thinking about inheritance tax, the better, I'd say in general.
Why is inheritance tax advice needed then, if it's easily avoidable and you can start really thinking about all the various opportunities available to you at any point in your life?
So it really comes down to, ultimately it can be seen as a fairly simple tax, 40%, but we all know the devil's in the detail. And there's a lot of pitfalls that we need to think about when carrying out tax planning for individuals. And falling foul of those, that can be very costly. And ultimately, that's a burden on your family, on your loved ones who you're going to leave those assets to.
What assets are actually taxed under inheritance tax?
So I think if we talk about it in the context of a UK resident, UK residents are going to be taxable on everything they own worldwide, no matter where it is. There's going to be some assets which qualify for certain reliefs, and there's going to be gifts to certain people that qualify for exemptions. And we'll probably cover that a bit more later on.
Okay, thank you. Alrighty. So without much further ado, let's just get into the detail here and answer some of the most common myths that we're hearing over at Shorts. So Craig, I'm going to pass the first one over to you. I don't need to worry about inheritance tax. It only affects the wealthy.
Yes, this is a misconception, I think, because broadly, anyone who has assets above 325,000 is potentially affected by inheritance tax. So 325,000 is what's known as the nil rate band. So if you have assets below that level, then there is no inheritance tax to pay. If you add up the value of your home, the value of your bank accounts, the whole everything you own, your personal possessions, for quite a few people, that will probably come to more than 325,000. So you might not consider yourself to be particularly wealthy, but you could still be affected by inheritance tax.
Wealthy in terms of inheritance tax isn't necessarily the same as wealthy that you might think about of, the elite having massive yachts and all living in Monaco. Wealthy is just having enough to hit that threshold where you're going to pay tax.
Yeah. The 325,000 threshold, that's been in place since, I think, 2009. So if you think about over the last, 17 years now, property prices have risen dramatically. More and more people are getting dragged into the inheritance tax net. So more and more people are being affected by it and need to think about planning.
It's an interesting point that you've made, because I think there is this assumption that when they think about assets, it's just things like money, jewelry, family heirlooms, etc. But actually, assets can be everything in your whole estate.
Mm-hmm.
One question I did have was, well, how is that valued? How is somebody looking at my climbing gear, for instance, and assessing how much that is worth?
Yeah. So it's valued at the date of death. So that's an important point to flag. So try not to think about the value right now. We're thinking about date of death. It needs to be valued by the executors. It needs to be done at market value at that time.
So it's going into that devil's in the detail, as you guys were saying earlier.
Yeah.
Mark, next myth over to you. I can just write my own will.
Yes, you can. Yeah. I wouldn't suggest it though.
No.
The amount of times we've seen someone write a will and it doesn't go well, for the sake of saving yourself a few £100 in lifetime rights in that will versus the cost, which can go into the tens of thousands.
Yeah, absolutely.
For your executors trying to put right the errors you've made. I would never suggest that. But
so what are some of the most common errors that you are seeing when people approach you and say, I've already written a will, it's covered, we don't need to think about that?
So for me, there was a gift that the father had accidentally left to the son, and it was intended that it would go to son and daughter. Luckily, son and daughter got along well, but there was an impact on the son to try and correct that mistake, and that caused tax implications for him. So it's, even if the family get along great, the issue is still, well, how do you fix those mistakes afterwards? And I think you've had examples as well, haven't you, where the family don't get along as well. So
yeah, we've seen it from the other side where it goes wrong. So it might be tempting to try and save some money on day one. You might think, it can't be that difficult. I'll write it myself. But yes, we've seen it go wrong, haven't we? We've seen it at the other side. Causes a lot of undue stress for the family. Often it can result in a higher tax bill, a higher inheritance tax bill, a lot of aggro. So for the sake of a relatively small amount of money, I think it's worth getting that will right. Making sure that you're not just writing a will to determine who gets what. It's also thinking about the tax as well, how the tax fits in with the will. The will is the document that expresses where the assets go, which family members you want to receive which assets. But at the same time as writing the will, you also need to think about the tax. How does this fit in with the tax system? If I structure the will in that way, will that result in a higher tax charge? So it's certainly not just the case that you need to think about the will and nothing else. Tax planning works in unison with the will, I would say.
Yeah, definitely.
Okay, guys, so I'm going to play devil's advocate here for a second. Let's say theoretically I go and pay to have a will written out properly for myself and my family. Is that all I need then to do towards estate planning, or is there something else I need to do?
I think the way I see it is the will is a basic to get done, but to get it done right and to make sure that you're achieving what you want to achieve, and that key factor of making sure you're getting as much of your wealth to your family, your loved ones, as possible, you want to make sure that you are doing it in the most tax efficient manner. So that's why you want to supplement that with the tax advice. So the will takes care of the legal aspects, the tax planning, make sure that you get as much wealth as possible.
Cool. So it almost sounds a bit that the will is to make sure that all my assets and my wishes are carried out in the way I want, but then the estate plan is that it's carried out in the most efficient way for my family then.
Yeah.
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 Okay.
Yeah. It's not an either or. Both aspects are important.
But let's just say it's just me and my partner and I pass away and I just want to leave everything to my partner by default. Do I still really need to do a will and estate planning?
I suppose the short answer is yes. So if you were to leave everything to your partner, the spouse exemption may well be available. So just briefly in terms of the spouse exemption, if you were to leave an asset to your spouse or civil partner, that there is no inheritance tax due on that at all. I should just point out that if you are cohabiting, you're not married, not in a civil partnership, that exemption isn't available. So that's something to be mindful of. So the spouse exemption will typically cover the inheritance tax position on the first death. We tend to see the inheritance tax being due on the second death. So on the second death, the surviving spouse often has all the assets in their name, and that's when we can see the inheritance tax liability.
So it's almost like delaying that responsibility then?
Yeah, it's a case of looking at the bigger picture, really. Not necessarily thinking about, okay, what's happening on the first death. It's the bigger picture, making sure it's joined up and there are no sort of nasty surprises on the second death. Yeah.
And so just wanted to stop on a point you'd made earlier. The same rules, it sounds, don't apply if you're long-term cohabiting partners, but you're not officially like married or potentially even living together, but you have been together for a long time.
That's right. So you could have been cohabiting with someone for 20 years. You could have 6 children together. That doesn't give you the tax exemption, unfortunately. It doesn't give you the spouse exemption. You have to be married or in a civil partnership to be eligible for that one.
Alrighty, so moving on to our next myth. Giving assets away reduces inheritance tax. Mark, I'll fire that one over to you.
Yeah, so again, this is true. Giving away assets does help with the inheritance tax liability. However, there's a few things you need to be aware of. Some people may have heard about the 7-year rule. So those gifts need to be more than 7 years before you die. If you make them more than 3 years before you die, then you might get a little bit of extra tax relief on it. But that's what we're looking at. And then the other aspect is to make sure that you don't benefit from those assets, because if you do, then they're going to be clawed back into your estate for inheritance tax purposes. And you can see this from the perspective of the taxman. You know, how fair would it be to give something away and yet still just enjoy it? That's not going to be fair, is it, in that sense? So they will claw that back into your estate and make sure you're still taxed on it.
Okay.
I think ignoring the tax position for a second as well, it's quite nice to be able to give assets away during your lifetime, whether it's cash or property, and see your family enjoy that asset during your lifetime. Obviously, besides the tax position as well.
Yeah.
So obviously there may well be non-tax reasons why you might want to make those gifts during your lifetime rather than through the will.
And it may not just be cash as well. It could be you give an asset which produces an income. So, you know, when your family are younger, sort of, you know, young family, let's say, of you can effectively give them an asset which will produce some income for them, support them in that sense.
Yeah. And as Mark highlighted, it's important that if you are giving an asset away, that you no longer benefit from that asset. Otherwise, for inheritance tax purposes, it just doesn't work. The value of that asset will remain within your estate.
So you said we mentioned the 7-year rule. For some people, 7 years might seem like quite a long time to be planning. What if, you know, they do go and give something away with the intention of trying to plan in advance, but they pass away 5 years after they've given it? What happens then? Is there some level of leniency there?
So if you survive the gift by at least 3 years, then taper relief may be available. So there is a relief called taper relief that can be available. There are lots of misconceptions about taper relief. So taper relief, number one, it reduces the rate of tax that's payable on that gift. It doesn't reduce the value of the gift. That's a common misconception that we see with clients. Another thing to flag with taper relief is that often it's not relevant. So let's say, for example, someone makes a gift of £10,000 or even bigger sum, £100,000. That would be below the nil rate band, below the 325,000 exemption. So in that case, there wouldn't be any inheritance tax to pay. So it's not always relevant. Taper relief is more relevant where the gifts are more substantial. So we don't see it as often, do we, in that scenario?
There's going to be people out there that are going, I don't know, what tomorrow is going to bring. I just want to make sure my family benefits as much as possible. End of story. So theoretically, this is another myth suggested by someone. What if I just bought cryptocurrency for cash abroad, transferred it to a cold wallet, and then gifted those to my kids? Is that even something that can be done?
I think there's no distinction there between, as Craig said, giving £100,000 or giving a cold wallet with cryptocurrency in. They're both your assets. They're both something you own, and it's both going to be a gift. So in that sense, the exact same rules apply.
In terms of crypto, I'd just like to flag that crypto is subject to inheritance tax. We talked earlier about which types of assets are subject to inheritance tax. It's everything, basically, isn't it? So by putting money into crypto, that's not avoiding inheritance tax. It's still in your estate, isn't it? It's just in a different form. And as Mark said, the same gifting rules apply to crypto as they would do to any other asset or cash.
So there's no getting around inheritance tax with cryptocurrency either then, by the sounds of it.
No, but the gift itself may help you get around it if you can survive that by 7 years. Yeah.
Cool.
Yeah.
So 7 year is the key element there with anything towards gifting and inheritance tax.
Yeah,
it is.
And I think at this point it's probably worth bringing up that there's normally a bit of a yin and yang between inheritance tax and capital gains tax. So when you don't have an inheritance tax liability, there's a strong likelihood that you'll have a capital gains tax liability. So if you bought cryptocurrency, you've made a gain on it, you haven't sold it yet, you haven't done anything, so you haven't crystallized it, but you then gift that to your children. So for inheritance tax purposes, right now, that is free of inheritance tax. But for capital gains tax purposes, that will trigger a charge. So you pay capital gains tax in lifetime. And so it's often worth thinking about what's the impact for other taxes as a result of making that gift.
Move on to another myth now. Craig, can you avoid inheritance tax by just putting everything into offshore accounts and trusts?
So I suppose there's two aspects there. There's the offshore aspect and trusts. So in terms of the offshore point, no, you can't just move everything offshore to avoid inheritance tax. That's I'm assuming here that we're talking about a UK resident individual. The rules are slightly different if it's someone that's not resident in the UK. So no, if I was to put all my assets in Switzerland, for example, they would still be subject to inheritance tax because I am resident in the UK, essentially. So it doesn't really matter in which country the assets are located. You mentioned about trusts, whether you can put your assets into a trust to try and minimise your inheritance tax exposure. Trusts certainly can be useful for inheritance tax planning. We see them on a regular basis. We're involved with setting up trusts. But again, it's not that simple. You can't just stick everything into a trust and think, job done, no inheritance tax. It's important to point out that, let's say someone has £1 million worth of assets. If they were to put those assets into a trust, there would be an inheritance tax charge at that point in time. There'd be a 20% inheritance tax charge on anything above the 325,000 allowance. So, unfortunately, it's not that simple. You can't just whack everything into a trust. Job done. No inheritance tax. Unfortunately.
So we won't be sending a lot of business to the Cayman Islands anytime soon, by the sound of it. But what if I try to be a bit more crafty and put the house in my kid's name, for instance? Can I avoid inheritance tax that way?
we see this a lot, don't we? This is probably one of the most common things we come across. People will have spoken to someone down the pub and they've said, "Oh, I've done this. I've put our home in the names of the kids, so I don't need to think about inheritance tax. It's now outside of my estate." Well, no, that's not the case, is it? Unfortunately, for those people. So if you give away an asset and continue to benefit from that asset, so let's say the family home, we'll put the family home in the kids' names, but we'll continue to live there. For inheritance tax purposes, there's no benefit there. The value of the home would still sit within your estate. So that simply doesn't work for inheritance tax purposes. Generally, I think there are exceptions.
Yeah.
So in order for that to be effective, you would have to pay a market rent to live in your home. Not many people want to do that, and then your kids would pay income tax on the rent that you're paying to them. So you're creating that tax charge there. There is also the danger that you might fall out with your kids. Hopefully this won't happen, but there might be a disagreement and you could end up essentially being thrown out of your own home.
Yeah.
So it's not just the tax implications to think about, it's the wider picture as well.
Or say your children went through a divorce, they actually legally own that asset, they legally own your house, so that's part of the marriage settlement. You could end up losing half of that. So it's a difficult one, and there has been lots of schemes over the years which have tried to enable you to put your house into a trust or do something with your house and allow you to still continue living there. And over the years, everyone has been quashed. And the truth is, the family home is probably one of the more difficult assets to do some inheritance tax planning with.
So for people listening to this, then it sounds like it's very hard to be efficient with how you work with inheritance tax in your property. You can't try to get around it through offshore accounts, secret crypto accounts, and then you do have to do a lot of planning for your assets. So there's this other myth off the back of that then that's come to the fore where people question, well, there's nothing I can do about inheritance tax, so why worry about it?
There are certainly things that can be done to reduce the inheritance tax exposure. It might not eliminate it completely. It depends on the individual circumstances, but 9 times out of 10, when we're speaking to clients, there are things that can be done to reduce the exposure.
There's always something. I think it ultimately comes down to how much you're willing to sacrifice in order to achieve that. And sometimes that means reaching a balance of saying, okay, I'm happy to sacrifice this much, and I'm happy that means that I'll have to pay this much inheritance tax. It's not an ideal world where you get to eliminate it all completely and still continue with everything you had before the process.
Inheritance tax planning often involves giving up assets. So some people are reluctant to do that until a certain stage in life because they don't want to leave themselves short. So it comes down to people's attitude to gifting quite often. Also, I think sometimes people are reluctant to hand over the assets outright to their kids, particularly until they've reached a certain age. So we often are involved with planning involving trusts. Trusts can be very helpful in that situation. They can offer some asset protection, and sort of rather than at the age of 16, 18, sort of handing over the kids £200,000 and sort of hoping they spend it wisely. You can put it into a trust and have a bit more protection over that money.
So it sounds like people are planning for quite a long time because they want to live their best life during retirement, but it sounds like they also need to consider and have a bit of time for retrospection about what that looks like for themselves, but then also the future for their families as well. And make sure that, I don't know, for instance, they don't give the money and then it gets blown on big weekends in Ibiza.
Yeah, absolutely.
Yeah, there's nothing wrong with big weekend to Ibiza.
We all love a good break, right? So just a follow-up, like mini myth to that then. If I've got a business, I don't have to pay inheritance tax on that then.
First thing I'd say is, what sort of business are we looking at here? is it a trading business where you got manufacturing, let's say, going on within the business, or is it a property business where you're investing in property and getting the rental income from it? Because that'll dictate whether you get certain reliefs or not for inheritance tax purposes. So let's say it is a trading company and it does qualify for those reliefs. What assets does the company own? Does it own any investments? Has it got lots of surplus cash? Those are the things that we would typically look at to see whether you're really going to get all of that relief. And then the next thing is the value of that interest you've got in the business, is it more than 2.5 million? Because if it is, it's going to be subject, the amount that exceeds 2.5 million is going to be subject to inheritance tax at 20%. So these are the things that we really think about when looking at it. And it's not as simple answer as you've got shares in a business and it's trading, it'll qualify.
Yeah, so it depends on the type of business, the value of that business, and what's happening within the business. So is there lots of cash sat inside the company? Has the company invested in property or stocks and shares, that kind of thing, which becomes investment activity? So it's not always as straightforward as you might think. Sometimes it's a case of just reviewing what's happening inside the company, what's the value of the shares, just to get that comfort that yes, we should be okay. The value of the business should be covered.
So it sounds a bit then from what you said that certain businesses will be targeted more with inheritance tax than others then?
I would say it's not so much that they're targeted, it's how the rules apply. Going back to it, devil in the detail. Always the devil in the detail. So.
And if you have individuals that approach and are trying to be clever with how they describe their business, then is that something that they can easily do? Or for instance, they've got a property business but they're hiding it as a chain of nail salons. How does inheritance tax treat a business like that, for instance?
Well,
I think there is no hiding, really.
There is no hiding, no.
I mean, with a company, your information is publicly available in terms of you're putting your accounts on Companies House website. And, when you die, it's perfectly within HMRC's powers to say, let's have a look at that business, let's see what you're doing, and they'll want to inquire into it.
Yeah.
So if we're going back to the conversations on gifting, one common myth that's bandied around a lot is I can only give £3,000 a year to my children. If I give more than this, I'll have to pay tax on it straight away. Is that true or false, Craig?
Yeah, so that's not necessarily the case. There is a £3,000 annual gifts exemption. So Kirsten, I could give you £3,000 this year.
Craig.
And that will be completely free of inheritance tax. That £3,000 exemption is per donor, so it's not per recipient. So I could give you £3,000, or I could give Mark £1,500 and you £1,500. So it's the total per donor.
I'm much happier with that.
Because Mark and I can hold you to that, right?
So it's certainly worth using that particular allowance. If you haven't used it in the previous tax year, you can carry it forward to the current year as well. So I could give you £6,000 if I hadn't used it in the previous year.
And how far along? Is it just up to the years, to the giving? If you don't use it the year previously, you can give it the next year?
You can only use the previous year's
Just
unused allowance.
So I can't try to be clever and save it up and then give like 12 grand.
Unfortunately not. No. The maximum is 6,000, assuming you've not used it in the previous year, and then in the following tax year it would revert back to 3,000. Also, if you were making a gift as a wedding present, so let's say you had a son or daughter getting married, you could give them £5,000 as a wedding gift.
Per parent.
Per parent.
Yeah. And if you're a grandparent, you can give £2,500. So if you've got 4 grandparents, 2 parents, you could easily get £20,000 inheritance tax, fully exempt.
So it's certainly worth making the most of those particular exemptions, and keeping a record of it as well, so that when the time comes and the executor is looking through the bank statements and sort of saying, what was this £3,000 for? What was this £5,000 for? There's a record there to support it. This makes things easier further down the line, doesn't it? So certainly use those exemptions, and Another thing to flag as well is that if you are making a gift to charity, you could give as much as you want. It doesn't have to be 3,000. It could be 10,000, 100,000 if it's to a qualifying charity. So there is that exemption as well that can be quite useful. To go back to your original question, you said, is it possible? I think you were sort of thinking, is it possible to give more than 3,000? There are circumstances where you can give away more than £3,000 a year free of inheritance tax. So this depends on whether you have any excess income. So that the starting point is to look back over the last tax year, total up your income for that year, whether it's state pension, rental income, whatever it may be. Look at your expenditure during that year, including things like holidays and other purchases of that nature. Did you have anything left? Was there any excess income? If you did have some excess income, you can potentially give that away free of inheritance tax. But there are a number of conditions attached to that. So it's got to be a regular gift of income. So typically it's at least every year. It might be every 3 months, say. So you might want to give your child or grandchild, let's say, £5,000 every quarter, every year, whatever the number may be. And provided that's coming out of excess income, potentially that's outside of the scope of inheritance tax. But so there are some conditions attached to that. Again, it's important that you keep some evidence to show this money is coming out of excess income. It's not coming out of savings in the bank or what HMRC would deem to be capital. So again, the record keeping is really important. And the executor, if you've got that record keeping in place, it makes the executor's life a lot easier, doesn't it?
Yeah, and it saves costs as well. I mean, ultimately, if you're expecting professionals to go through your bank accounts for the last 7 years, looking at what expenditure you've had, what gifts you've made, and work that out, think of your credit card statement at the end of the month, just that alone, and then times that by, 7 times 12, it adds up, and it's a lot of work to go through. So you can save that cost because you can do it as you go along.
Yeah, but there has to be that intention to do it on a regular basis. It can't be a one-off gift of income. It has to be a regular thing, doesn't it? And that could be to anyone, kids, grandkids, nephew, neighbour, whoever you like. Yeah.
So it sounds like there are ways around this, but it just requires good planning, good timekeeping, and good record keeping, at least for the poor tax advisors that have to go through all of your paperwork and estate and start looking at how this all fits against inheritance tax then.
Yeah.
Yeah.
Absolutely, yeah.
Cool. Just try to make it easy for them then, guys. I'm going to fire the next myth over to you, Mark. How will HMRC actually know what valuable items or cash I own? I can just tell my kids where to find them in the house and they can just come and collect them.
I work on what you can do and what the law allows you to do. If I just say that HMRC systems are increasingly becoming more sophisticated and their powers are ever increasing as well in order to request information, there's very little place you can hide. And we could talk about how HMRC could or could not spot that you had these assets. But really, I don't see there's much merit in that, because if you've got physical assets and you want to give them to your children anyway, why not do some tax planning with them and do that in lifetime? That makes more sense. And then everyone can sleep at night knowing they've done the right thing and also done something that is inheritance tax efficient and is within the law.
It almost sounds a bit like, even if you think you've gotten around HMRC's systems now, they're always changing and developing. So whatever, it could be a few years from now, they can't access something that you think you've covered or hidden away.
Yeah, exactly. Yeah.
Yeah. There are legitimate legal things that you can do to improve the inheritance tax position. So I think I'd recommend that people focus on those rather than tax evasion, effectively, trying to avoid people spotting those assets or evade the tax liability.
So if anybody comes to you with scavenger hunt maps of where their assets are hidden, assets hidden in riddles for their kids, they're just going to go in the bin then, by the sounds of it.
Yeah.
Next myth, over to you, Craig. My mate at the pub or golf club told me I could just invest in a scheme he's heard of and I won't have to pay any inheritance tax. Is this true or false?
Okay, so we're talking here about tax avoidance schemes by the sounds of it, inheritance tax avoidance schemes. I think generally what I'd say is if it sounds too good to be true, it probably is. So steer well clear of these schemes. Often with these schemes, there is a requirement for whoever's creating the scheme to inform HMRC about the scheme. So it tends to be that it's then on HMRC's radar, and HMRC will look at it at some point. So no, I think our advice is don't entertain those schemes. Typically, they lead to problems further down the line. Often big tax bills further down the line. Lots of costs involved. So
Yeah, I think long term, the only people it benefits are the scheme providers who take a fee for it and accept no responsibility if it goes wrong, and the professionals who have to unravel it, because it's always the taxpayer who falls foul and ends up long term having to pay the tax.
yeah, as I say, if it's too good to be true, it probably is. It probably doesn't work.
It sounds like HMRC might have a few questions for your mate down the pub as well.
Yeah.
Next myth, my pension isn't included in my estate for inheritance tax purposes, so I don't need to pay any tax. Mark, is that true?
Today, right as we sit here, yeah, that's true. And typically it's always been a part of inheritance tax planning that we've always said, leave your pension till last, don't touch that, spend other assets that you've got, because that benefits from an IHT exemption. However, from 6th of April 2027, that all changes.
Yeah.
So from 6th of April 2027, pensions will now be in your estate. And this is a massive change for a lot of people. Where they didn't have inheritance tax problems before, they're now going to have a really big issue. And it's something that we need to really think about carefully and what to do with that pension.
Yeah, this is very topical, and I think many people are unaware of this change that's coming in, as Mark said, in April 27. So many people have large sums of money invested in their pension pot that will potentially be subject to inheritance tax if they are to pass away after April 27. So now is the time to start thinking about that. Should they be doing things differently? Are there steps that they can take to try and mitigate that exposure? There is a window now to look into that and try and take some advice.
Yeah. And currently it's quite cruel because you're paying inheritance tax on your pension, and then potentially when your family come to extract it, they'll pay income tax, which could be up to 45%. So you're getting a double whammy. Feels really unfair.
Yeah.
Can I just ask then, because I think this is something a lot of listeners will be questioning listening to this, why is this new rule being introduced now then?
Good question. I think there's a perception that certain people have put, and perhaps there's truth in this, that certain people have put lots of money into a pension pot to try and avoid paying inheritance tax. So I think this measure is designed to try and counter that, to stop people avoiding inheritance tax through that mechanism. But there is, at the moment, as things stand, there is no threshold, is there? It's basically all pensions are effectively caught by this. It's not all pension pots above a certain value. So arguably a higher threshold or some sort of threshold might have been a smarter way of doing it.
Yeah. I think the idea is that you get income tax and capital gains tax benefits in lifetime when you're paying into your pension. It's tax free in that sense. So the government's view was, well, then when you're taking it out at the other end, it's also inheritance tax free. How does that feel fair? It's tax free throughout it all. I suppose without getting political, the risk of getting political, the governments have encouraged people to want to save and put into their own pensions. That's what people have done. That's why there are these tax incentives. It feels like yet another knock on those people who have saved and have put away on that promise that they're now going to have to pay inheritance tax. So I think we definitely feel people's pain on it.
Yeah, massive change. And I think people need to start looking at that particular issue sooner rather than later to give themselves time to plan.
And just a further question then on the pensions. I know there's going to be quite a few people out there going, I've had quite a few jobs in my lifetime. There might be pension pots out there that I paid into that I'm not even aware of. So what next steps should I be taking then? Because I actually have no idea what's in my pension potentially.
I think step one is establish the facts. So how much is in each pension pot? Contact the different pension providers to get that information. And then once you have all the information to hand, you know exactly what you've got. You might at that point want to speak to a financial advisor as to whether to consolidate some of those pension pots. But yeah, you're then in an informed position to decide what to do with the pension pots.
Yeah, definitely. I think seeking financial advice is a really key part of that. So getting in touch with a financial advisor who'll be able to advise you on what's the best pensions, where the charges are, and what the implications are of you doing anything with those pension pots.
So setting pensions slightly aside here, what about ISAs? I don't need to pay any inheritance tax on those, right?
That is incorrect.
What?
Kirsten.
No.
ISAs are subject to inheritance tax. Many people think, oh, it's tax-free. I don't need to think about ISAs. That's tax-free. It's free of income tax, but not inheritance tax. So we do need to think about inheritance tax with ISAs. Again, it catches quite a few people out.
Yeah.
But
I think of it a bit like a pension in the sense, or how the pension rules will be, that they're free of income tax and capital gains tax in lifetime, but on death they're like any other asset. But there are a few things that you can do on death. So if you leave it to a spouse, then there won't be any inheritance tax on leaving your asset to your spouse. And then your spouse can make an election to transfer that ISA into their ISA, into their name as well. And then they continue getting the benefits of the income tax and capital gains tax exemptions in lifetime.
Okay, so inheritance tax will target ISAs, but there are ways to be very efficient about distributing the money or what's in there.
Exactly.
Sounds of it, yeah. Thanks, Glyth. So those are all the myths that we've got covered today. Before you guys go, though, Craig, I was just wondering, what's one thing you would want people to take away from this podcast episode today?
One thing. I suppose it's probably don't bury your head in the sand. Obviously, none of us really like to think about our own death, and it's quite a morbid topic. But at the same time, we want to make sure that our affairs are left in a good order for the next generation. So I think try not to bury your head in the sand. Take action now, even though it might not be something you want to think about. Do it, bite the bullet, and do it. And as we touched on earlier, sometimes the earlier you start thinking about inheritance tax planning, the more options you have and the more you can do. So try not to put it off, I think would be my sort of main takeaway.
Well, and Mark, what would you want people to walk away from remembering from this podcast?
I would say there's always something that can be done. There's always something that we can do to improve the situation. And ultimately, when thinking about, even if something can't be done, it's better to know what you're dealing with and be able to quantify it so that you know what your family are going to have to deal with and you can prepare for that, whether it's making sure there's enough cash there to pay for it or taking out maybe life insurance policies. So there's always something.
Yeah.
Thank you both. I really appreciate you taking the time to sit down with me today and go through all the various misconceptions and provide a bit of clarity on the subject.
Yeah, lovely. Thank you for having us.
Yeah, it's been a pleasure.
So, as you've heard today, inheritance tax can be complicated and misconceptions abound around the topic. The most important thing that you can do, though, as Craig and Mark have suggested, is not burying your head in the sand and go and get some practical advice on your personal circumstances to help give you and your family some peace of mind. If you want to speak to an inheritance tax specialist, do give the Shorts private client team a call or drop an email, which you can find in the show notes below. Otherwise, subscribe to Accountable by Shorts to get updated on when our next episode is. Thank you for listening or watching, and we'll see you again soon. Bye-bye.